So what is the big question of the day? What return on investment should I assume when calculating my wealth gap? Yeah, and welcome back to the Financially Simple Experience. I'm your host, Justin Goodbread, and today we're trying to wrap up or get close to wrapping up this idea behind a wealth gap. Now, someone brought it to my attention that the wealth gap that we're often communicating is the difference between income from individuals not making, say, lower middle class or lower class, I don't say that lightly, to those who are in the high income brackets. Oftentimes that's referred to as the wealth gap. That's not what I'm talking about. What I'm talking about in the terms of wealth gap is where are you at today compared to where you need to be. And I use this analogy to help us understand what we're looking at when it comes to our retirement or when it comes to our wealth. So I live on the Tennessee River. It's about a mile wide, about where our house is on the river. And when I go down to the riverbank, directly opposite of our side of the river, I can see this gorgeous two-story dock that a boat would go underneath, and you could have like a sunbathing or a jump off. If I was a kid, I'd jump off the top story into the river. It's about a mile across the river. And we can make that kind of assumption that, hey, we know where we're at today. We know where we're at today in terms of our current net worth. Whether it's good or bad in our eyes, we know where we're at. And we've spent the last 6 or 7 episodes, 9 episodes on the Financially Simple podcast. For those of you who are watching us on social media at this particular point, hey, check it out on financiallysimple.com, or you can download the Financially Simple podcast through iTunes, Stitcher, Spotify, iHeartRadio, wherever your heart takes you as your favorite listening device. And please, while you're there, please subscribe and leave us a review. This helps us advance in the rankings in the podcast. But nonetheless, we've been dealing with this wealth gap, and we've talked about so much. We talk about real estate investing. We talk about business. We've spent time talking about how inflation could work, how taxes could deal with, and now I want to deal with our investments. And you say, Justin, you're a financial person. You should deal with investments. I got to tell you, I've recorded almost 300 episodes on the podcast, and I think I can count on my one, maybe 2 hands, the issues or the conversations I've had around investing. See, because finance is so much more than investing. Investing is so much more than finances, and finance is so much more than stocks, bonds, mutual funds. But today I need to deal with this idea behind investing because I've seen a lot of people recently cause some problems in their assumptions. And so I want to deal with what assumption should we assume when it comes to planning. Now, as you know, we are certified financial planners. There's several of us within our organization who work with clients nationally, business owners and non-business owners alike. I like the business owner side. It's a little bit more challenging to me, but we have advisors that solely work with those of you who are not business owners. And this is a calculation that we deal with day in, day out. We want to know how much more we have to do, how much more our net worth needs to grow before we can hit our retirement, or before we can sell our business, or before you can buy that house, or before whatever your goal is. So I need to first give this disclaimer because today we're dealing with indexes and securities. So I want to be crystal clear. This is not investment advice. I want you to talk to your advisor. If you don't have an advisor, reach out to us. This is what we do every single day of the week. And I also want to make sure we're all clear on that past performances, what's happened in the past, is not indicative, or probably is not going to tell us what's happened in the future. And if we try to make the assumption that just because it happened in the past means it's going to happen in the future, that's actually a federal offense. The statement goes like this: past performance is not indicative of future results, and any assertion to the contrary is a federal offense. So I'm not saying today on the show that just because something happened over the last 10, 15, 20, 100 years, that it's certainly going to happen in the future. That is not the case. We're not going to use that as a baseline, but we can learn some things from history. So I want to start with one of my favorites. I like to quote Dave Ramsey. I first read his book, almost 15, 20 years ago now, probably longer than that. His book called Financial Peace. In fact, it's one of my favorite books. He brings in scripture into the world of finance. And I love any time that you can look at money through a biblical lens. You know where I stand on my belief with Christ and God. You know where I stand with that. But anytime I can look at a subject through the lens of Scripture, I think it does great. So Dave Ramsey wrote a great book called Financial Peace. And in that book, I remember reading this statement. He said, you can get a 12% return on your investment. And he made that statement, and over the years, he has been ridiculed. He has been attacked. So much so, he actually put a web page specific to that particular statement on his site. And I'll have a link to it in the show notes on the financiallysimple.com. If you've never visited that before, check it out. It has several hundred articles on how we business owners can grow our net worth. But if you look at it, what Dave specifically was dealing with was the average annual return from 1923 of the S&P 500 through 2016. And at that particular time, and he cites a source, it yielded a 12.25% return. But there's more that meets the eye than that particular equation. For example, if we move the date range from, let's say, January of 1923, let's say we move it to January 1923 to December 31st of 2019. Let's just move it 3 years later versus stopping it on December of 2016. If we do so, then we actually drop the return from 12.25 down to 10.48. Well, if we started the number instead of 1923, we went to January 1st, 1999, we would actually move that number from 12.23 down to 6.68. That's just a 20-year time frame. Well, if we look at roughly a 10-year time frame, we went from January 1st of 2010 of the S&P 500's return to December 31st of 2019. Then that time frame, the market, the S&P 500 using that index, yielded a 13.5% return. And yet again, if we go to 1990, and we pull roughly from 1990 to December 31st, 2019, it even drops down to 9.96% return. So why am I saying that? Well, because time frame matters. Dave Ramsey quotes a specific time frame, and he's accurate in his assumption. But does that mean we should use a 12.25% return for our assumptions going forward? I mean, what if? What if the next 20 years of our life yields the same thing that happened from January 1st, 1999 to December 31st, 2019, which only gave us a 6.68% S&P 500 return? What would that do to our plans? So see, time frame matters. Let me go one more step further, not to confuse you or complicate things, but we also have to look at the dividend rate. If we remove the dividend from the S&P 500, and dividends are affected by interest and affected by the capital markets, the business cycle, there's a lot of different things that affect the dividend rate. So if we pull the dividend out, get this, from January of 1923 to December 31st of 2019, the S&P total return was 10.48, but if we remove the dividend, then it dropped down to 6.26. If we did this, if we removed the dividend from January 1st of 1999 to December 2019, it drops from 6.68 down to 4.68. So removing the dividend over a period of time frame also affects things. From March 28th, 2013, the S&P ended just above 1569. Why is that a big magical number? Well, it set a new record close. So that was March 28, 2013. Think about your time frame. The S&P ended above 1569. And it set a record closing high, surpassing the previous milestone set in 2007. So from 2007 to March 28, 2013, the S&P was running in negative territory. What if the next 7 years is like that? You know, we ended up with the lost decade, as they call it, from 2000 to 2009, and that was right after the 9/11 terrorist attack, and the S&P 500 went through some tough times and actually yielded a negative 1% return during that decade. It's pretty amazing when you start thinking about this. Now, I agree with the assertion that the markets, the stock market as a whole returns positive territory over a 10-year period. It does, for the most part. There are these anomalies like the lost decade we just referred to. See, if you look at your start dates of, let's say, 2000 to 2009, you end up with a negative 1% return. So whenever someone says, hey, I can get a 12% return, over what length of time? Are we talking about the next 10 years? Are we looking backwards, trying to say what happened in the past is going to happen in the future? We can't do that. We can't do that. Another thing we have to look at is not just the time frames, the bookends, as I call it, the starting and the end point. We also have to look at the economic cycles. Where are we at in the economic cycle? So here's where it gets interesting. While stocks have actually beaten the inflationary rate over a long time, they've actually done very poorly during high inflationary periods. Now, I did an episode probably 6-7 episodes ago talking about how inflation can affect our portfolios and our net worth and ultimately our wealth gap, as we mentioned earlier, over a period of time. And we looked at, hey, with the $3.6 trillion that was printed from the CARES Act this year in 2020 and all the apocalyptic things that we're dealing with in 2020, could it actually cause inflation to move in? Well, it could. We actually identified that. If we add some details to this and we say from January 1st, 1916 to December 31st of 1918, the stock market, in this case, yielded a 1.32%. However, if we take dividends out, it lost 5.59%. Again, it happened in 1946 to 1947. The market returned negative 5% during an inflationary trend, and because of if we took the dividends out of it, it actually went down negative 9%, 9.28. And yet again, the years that I was born, from 1973 to 1981, I was born in 79. So from 1973 to 1981, the market, the S&P 500, hit a 5.08% return. But if we pull the dividends out, we only made 0.42. So I ask you, what if we are on the cusp of 1973 today in our historical time frame? And now we're looking at an 8, 9, 10-year period ahead of us where, aside from dividends, we make a 0.42% return on our investments, on our stocks, bonds, mutual funds. You say, Justin, that's sickening. Yeah, more importantly, the biggest struggle I have is if you're planning on a return of 12.25%, as Mr. Ramsey said in one of his posts from back in 1916, then you could be way off the mark. You see, so these things matter. Your assumptions matter when you're trying to calculate where you're at on this journey to grow your particular wealth. As I'm looking at this inflationary thing, I go back to my question, are we running into inflationary trouble? Actually, I spoke about that, as I mentioned a second ago. JP Morgan actually released an article just this morning, as I'm recording this live, today on 9/28 at roughly 4 o'clock in the afternoon. For those of you who are hearing this on the podcast, JP Morgan stated, despite a formal shift to average inflationary targeting, the Federal Reserve, or the Fed, forecasts suggest inflation will not reach 2% for 3 years. So that is released today. So inflation in the next 3 years, JP Morgan's analysts are saying, no, we don't think that's going to happen. So if we're not worried about inflation and we're not worried about a downturn of a stock market theoretically because of inflation, what about the economic business cycle? What about the economic business cycle? Where are we at in the cycle? So I often refer to the economic cycle as 3 points. Some people refer to it as 4. So I'll give you the 3 and the 4 points. We talk about an expansion, a recession, and recovery. So where are we at in that? Are we still in this expansion mode? Did we just go through a recession, or are we in a recovery? You know, I have analysts that argue those 3 points on a daily basis. Here we are. We've gone through COVID. We did have the market fall way back. Some would argue that was a recession. And now they're saying we're in recovery. Well, if we're in recovery, then perhaps we're going to expansion next cycle. It's oftentimes hard to really measure where you're at in that three cycle or 3-step business cycle. So then we look at the cycle that has 4 steps. It says that we rise, we peak, we dip, and then we bottom out. So that looks more like a square, okay? It goes up and down and over. So we rise, we peak, we run laterally for a little bit, we dip, and then we flatten out on the bottom. Then we rise, and we peak, and we dip, and then we bottom out. Where are we at in that series? It's hard to often tell. So I look at it through 3 different, let me get a little more technical on some cycles. So we deal with 3 different types of cycles. We deal with what's called a secular cycle, which is a 10 to a 30-year period. It's a long trend. It's long and flowing. And we can look back through our history and see that we've had secular cycles of 10 to 30 years. We also deal with the business cycle, which is what I was looking at, which is a 1 to a 10-year period of time. That's a 1 to a 10-year, and so it moves a little bit more fluidly through that secular cycle. Then we have a tactical cycle, which is a 1 to 12 month, which is what we've just referred to this year. Man, if you look at this year, it spiked way up. We began the first part of the year pre-COVID, and it was like, man, gangbusters, all holds bar. Then all of a sudden, man, we fell way down. And then we recovered, and now we're falling a little bit. Who knows what's going to happen between now and the election and thereafter. So that's called a tactical cycle. If we look at a cycle type investing, then we can actually look and say, well, during certain cycles, certain segments of this cycle, there are areas or sectors which actually provide us a theoretic better return. Now, I said theoretic because I'm going to use some disclaimers here. But again, Fidelity, in this case, they did a really good illustration showing basically they pulled all the different cycles together and said, okay, if all things being equal, which, by the way, not all things are ever equal, if we're early in this cycle or during the growth side, then you have your financials, your real estate, consumer discretionary, information, industrials, materials. Those are some winners during that time period. And during a booming cycle, your healthcare, your energy, and your utilities during the rebound is often lagging. It's often in negative territory. Now, does that mean it's always the case? No, it's not. But if we're mid-cycle, then we start seeing consumer discretion and materials lagging, and we start seeing communication go up and utilities go down. And during the late cycle, we see consumer discretion, information technologies go down, while yet we see materials, consumer staples, healthcare, energy, and utilities go up. Now, if we're in a recession cycle, then we start seeing real estate fall. We start seeing information fall, industrials fall. We start seeing consumer services fall, yet we see consumer staples kick up, we see healthcare kick up, and we see utilities kick up. Now, is that an always? No, it's never an always. Before you say, man, I know we're currently in a late cycle right now, I'm just going to load up on consumer staples, be careful. The cycles are not always consistent. They're not always in step-by-step, lockstep. The cycles are not chronological. It's not always the case. Sometimes they miss a step. We've seen this in our history. Key sectors may not always flow just right because the market is irrational and the markets have no sense sometimes. Just because we think they're going to do something doesn't mean it's going to do it. See, the irrationality of the market is why Nobel Prizes have been awarded for theorems like modern portfolio theory and three-factor modeling. This is why in our office we use target band rebalancing, we use low-cost investing, we use broad-based diversification, because we're really not sure. No one is sure about what specifically the markets are going to do. I think if I were going to take that one statement I just said, no one knows for sure, you could actually go back on several of the videos that we have on our YouTube channel and look at some things that I've tracked back in history and shown where even the professionals think they have it and they don't. And then we hear the stock jockeys, you know, the friend who's always bragging about the stock that they just made or they bought, they put it on Facebook, they put it on Twitter, they talk about it on the water cooler, depending on your age demographic. And if you track it and you follow it over a period of time, man, sometimes they have winners, but oftentimes they don't. I know of one individual who told me not too long ago, he said, Justin, why aren't you buying cryptocurrencies? And he named a couple of specific currencies. And he said, man, you're losing out. I bought mine at X and now it's worth Y. It's like, great, are you going to sell it worth Y? Well, no, man, I'm not going to sell it worth Y because, and until of late, he actually was in a lost position. I don't say, my dad used to say, with son, pigs get fat, hogs get slaughtered. Okay. So whenever it comes to these stock jockeys, even they brag about the winners, but you never hear about the losers. And I have a friend of mine that he is a stock jockey in the professional world, and we compare one portfolio behind the scenes. It's not for public record use. It's just, here's what our specific portfolio, which best matches his specific portfolio. And it's just fun to watch the results of those two things. See, we can't choose where we're at in the cycle. We don't know oftentimes. You know, if you're born today, we've seen some amazing things in our time period. But if you go back in history from like the 1950s to 70s, or perhaps you were investing from, during that time period from 1973 to 1982 when there were high inflationary trends, man, you really can't choose where you're at in the cycle. You really can't choose what your returns are going to be. Some would argue right now that, hey, we may see 12% like Dave Ramsey speaks about. Others would say, man, you lost your mind. We're not going to see 12% again in my lifetime. And that's all assumptions. Here's what's certain. Over the long run, the stock market has, and here's your key, an inflation-adjusted annualized rate of return between about 6% to about 7%. That's the key. Does that mean always it's going to return 6 to 7% average? No, that's not what it means. But over the long run, again, your long run is going to determine, some would argue that's 20 years, some would argue that's 30 years. It averages, it's going to give you roughly an inflation-adjusted annual return of about 6 to 7%. But we have a problem even then. If we're going to use 6% as a constant or 7% as a constant in our calculation, we still run into another problem. That is what's called glide path. Glide path. So I want you to think of whenever you're flying in an airplane, if you see an airplane landing, it comes from, 30,000 foot all the way to the ground, but it doesn't do it instantly. It's not like a sports car that just hits the brakes. It takes many, many miles, hundreds of miles to get that airplane from its cruising altitude that the captain always speaks about. Hey, we reach our cruising altitude. You're welcome to take your seatbelt off and move about the cabin. It takes a lot of time to slow that plane down to where it's actually on the ground. I did skydiving about a year and a half, 2 years ago. It was one of the highlights of my life. I can't wait to do it again with my cousin, who's is a certified skydiving instructor. But we went up to 14,000 foot, which is, I think, the highest you could jump out at that particular point without oxygen or something like that. We went up to 14,000 foot on this airplane. And it took us a long time to get that airplane up to that altitude. And it took them a long time to get the airplane back down to the altitude. In fact, we got down a lot faster jumping out of the plane than the airplane came down. That's a glide path. Here's where that comes into play. Well, specifically, let me for a good glide path in detail. Glide path is specifically used as an asset allocation mix in a target date fund. Means the older you get, the more conservative the fund becomes. That's the technical use for it. Now, I'm going to adjust it some for a particular illustration because of holistic planning that we do. If we start off in an early phase and we say, hey, we're going to invest 100% of our money in the stock market, which so many young people should do, my opinion. Okay, again, talk to your advisor, but in my opinion, the younger you are, the more aggressive you should be in your investing. Why? Because you have time. And as we age, as we reach our target date, whatever that date may be for you particularly, we want to start bringing that plane down to the ground. We want to remove as much risk or volatility from that portfolio as possible. Now, there's a lot of factors. That's a general rule. Before the professionals we have hundreds of, maybe thousands of professionals who watch this, before you send me the dirty emails and the tweets and everything Justin always talking about, I'm talking generalities like I often do. Whenever we look at our specific wealth, our wealth gap, we know where we're at today, and we're calculating, hey, I've got 10 years left, I have 20 years left, I have 2 years left, I have 30 years left before I'm going to need my wealth to support me in whatever period of life you're looking at. We have to think about this in terms of a plane coming to the ground. Even the most successful investors will often diversify into asset classes that move opposite, what's called negatively correlated. They move opposite each other depending on where the markets are. And if that's the case, we're probably not going to see a consistent 6 or 7% return net of inflation over our lifetime. And that's one of those assumptions that people often mess up on when they're running a retirement calculator. They say, okay, I'm going to make 10% return or 12.25% return because that's what Dave said way back in 2016. That's what I'm going to make in my investment account in perpetuity. Friends, that's not the case. As we age, we start getting more and more conservative. We start protecting. We have the sandcastle effect. We're trying to protect our fortress from the waves, the inflations and taxes and risk and health and everything else that comes into our life. We want to protect it. So as you're running through your wealth gap, we've got to make sure we drop our risk. You're like, Justin, dude, this is crazy. I don't know how to do any of this stuff. This is why I hire a pro. We do this every single day. Sorry, I've been talking all day. We do this every single day in our firm. This idea that we can show business owners, we can show retirees exactly what you need to do to reach your desired goal. The reason why I bring this up is because recently I've seen a ton of people that are calculating the DIYs, do it yourself, that are calculating how much more they need to save. And they're taking unnecessary risk. They're taking risk because they want to be cheap. They think they can do it better themselves or lower cost. And the risks are just ridiculous on what they're taking in life. You don't have anybody to look at your elbows, so to speak, as a swimmer, professional swimmer has a coach saying, hey, pull your elbows in, get your body in alignment, hold your body straight so you can stream, so you can glide through the water. In our personal lives, especially the subject of the wealth gap, We've already hit on how to calculate your business ROI, and you need help with your business. That's why we all hire coaches, myself included. We know how to calculate our real estate ROI, and oftentimes we'll go to a seminar, we'll read a book on our ROI for our real estate, and we'll talk to professionals, expert realtors, title companies, whoever, to help us in our real estate. But when it comes to our investing, we just don't even consider it oftentimes. Or the more successful we are, then we realize how much true advisory needs we have. So my challenge to you is calculate your ROI. Run an assumption that's fair. We often use 6 or 7%. We often use 6 or 7% for young individuals, and that's an inflation-adjusted return. So we add inflation in, we add taxes, all these other things. But we use an inflation-adjusted of roughly 6 or 7%, which could be, by the way, 9 to 11, 12%, depending on the inflationary time period. Okay, so we use 6 or 7 in the younger days, but then as we age, we start backing that risk down because we want to make sure that there's enough coverage there to offset the what-ifs of life. This is how you calculate the wealth gap. So let me ask you the question. What is your gap in your wealth? We know where you're at today. You can do that on the back of your hand with a napkin. We know how much money you have today and what this is designed for you for income perspective. But do you know how much more money you need? And more specifically, how you're going to obtain that money? That's the question for you. So friends, the wealth gap is something you should be calculating very frequently. If you don't know how, reach out to us. This is what we do day in, day out. We love showing business owners. We love showing retirees, pre-retirees, how you guys can reach your desired goals. Look, I realize life is hard. We're dealing with sinuses here in East Tennessee. Pollen's falling. I was out mowing on the tractor. My throat's killing me, so you probably hear me coughing a little bit. Life is hard sometimes. I mean, who thought about sinuses here almost in October? But life is good. Life is amazing. Look at how blessed we are as a people. Life is amazing. And life can be frustrating. I mean, I just spent, 15, 20 minutes here talking about return on investment of a portfolio, and then at the end of it, I told you be careful, don't over assume. Yeah, life can be frustrating. Money doesn't have to be. Hey, look, let's continue to make our lives at least financially simple. Y'all make it a great day.